It's our great pleasure to welcome back to the show Barry Knapp for Ironsides Macro. Barry, thanks for making time for us.
Happy to do it.
Yeah, so the lots happened since we spoke last. I think we could probably start with the Fed. Last year, I remember you saying the Fed's made a policy mistake. They've gone too far in terms of raising rates. That's probably proved to be correct because the Fed is now guiding the other way. What is your take about, what the Fed, that evolution in terms of the Fed accepting that maybe they've gone too far and their new outlook for how we are going to go in the future?
It was interesting. I was listening to the television a few minutes ago and someone was saying, well, it's very different from a year ago. A year ago, we were worried about the Fed tightening too much, which certainly they were doing. But we do have to put some perspective around the whole process, which is they hiked 425 basis points in 2022, an additional 100 last year. I would argue at least 75 basis points of that hiking process last year was unnecessary. And quite frankly, taken in combination with a passive approach to QT, along with a very aggressive hiking cycle, the most aggressive since the Volcker Fed, they created the deepest yield curve inversion since the Volcker Fed. In fact, there's only been 3 occasions since World War II where we've had anything like this order of yield curve, order of magnitude yield curve inversion. We had it in 73, right before that very deep recession, one in late 79, one in 80. Now, the banking system was largely de-risked in terms of a lot of credit exposure, but we know they had off the charts interest rate exposure. And that is really why I was concerned a year ago that they were just going too far. They continued to hike even as we had bank failures, tried to, just address the problem with macroprudential policy. And, things were going okay. The banks were fairly uninvestable for a time, but the rest of the economy was muddling through. We know that interest rate sensitivity in the household sector is fairly low. People have turned out their mortgages. The same is true in the large non-financial corporate sector. I described it as an unstable equilibrium where you had small banks, small businesses, the real estate sector, and the government, for that matter, all really vulnerable to this deeply inverted treasury curve. But the large non-financial corporates and households, not so much. That was all okay until it became clear in August that the Treasury had some $500 billion extra in coupon securities for sale in the final part of the year. And the market had to back up to absorb that supply. And then the Fed decided, curiously, in September that rather than just riding the disinflationary wave, that not only did they want the disinflationary process to continue, and that was at the core of my thesis a year ago, was that, inflation, the path from 9 to 4 was very straightforward for CPI, that is. After that, it would get a little bit more difficult. So that first part of the year, we'd be riding that disinflationary wave. The markets would be responding favorably to that. However, what the Fed did in September was to essentially create a reaction function where they described inflation as the necessary condition, but additional labor market slack, a higher unemployment rate, what I'm now calling the quadrilemma or 4 fours. So additional labor market slack and weaker growth was the sufficient condition to get them to cut rates. When they, in essence, added that weaker growth, higher unemployment contingency to the rate process in September, they triggered just a second leg to the vicious bear steepening, which is the wrong way for the curve to invert when 10s went to 5%. And it was a pretty scary episode, almost approaching a sovereign debt crisis in some ways. They then, of course, pivoted off that and have decided to move on, and that policy is indeed excessive or excessively restrictive.
Okay, can we back up to that September meeting? Because I actually think your take is really interesting. I actually interpreted it as that the market was expecting them to pause, and they showed no signs of pausing. And I kind of had this theory that they were on 12 and a half beeps a meeting, which was a hike every second meeting. And when they said that they were still on that, that's what caused it. But I find your take kind of probably more probable than mine, in that you're claiming that they actually added necessary conditions for them to stop hiking.
I do. And I would add to that the actions of the Treasury in a lot of ways over the last couple of years have been more impactful on the markets than the actions of the Fed. And we could go back and walk through that. But when they added that contingency, and in addition to that, when you looked at their summary of economic projections, it wasn't just about whether they went, they were about to hike again or not. It was also about their forward forecast for the real funds rate. And so at that time, they increased those forecasts for the end of 23, but then we're forecasting an even higher real funds rate at the end of 24 and an even slightly higher real funds rate at the end of 25, right? Just using their core PCED and inflation forecast. Okay. That struck me as incredibly hawkish at the time. It was, for me, their third overly hawkish communication mistake throughout the entire process. The first one was in September of 22, when they hiked 75 for the third time, raised their terminal rate forecast by 80 basis points, and triggered a collapse in the yen. You recall the next morning, the Japanese had to intervene to the tune of some $21 billion to stop that sell-off in the yen. The pound flash crashed that Sunday night. The gilt market collapsed. Our mortgage market, U.S. mortgage market, went bidless. So that was mistake number one. Mistake number two was when Powell hinted at the monetary report to Congress, semi-annual monetary report to Congress in early March, that they might have to go back from 25s, which they'd slowed to as a consequence of that mistake they made in September of 22. But in March of 23, he hinted they may have to go back to 50s. And of course, within a week, we had bank failures. So this was the third hawkish mistake from my perspective. And it came at a really almost colorblind kind of moment where we were in this vicious bear steepening as a consequence of all that Treasury supply. And then they, in essence, said, we're not going to lower the policy rate below 5% for something like the next 15 months. You could extrapolate that from the summary of economic projections. And you've got to remember that Treasury Secretary Yellen, she had already lost her three best customers, that is to sell treasuries to.
Right.
Best customer was the Fed. Second best was the banking system. Remember, they bought about $1.8 trillion in treasuries in 20 and in 2021. In 2021, they bought about $1 trillion. And they were out of the market because this deeply inverted curve means, if you, other than for JP Morgan, if you have to pay 5% for deposits and you buy a 4% 10-year, that's a one-way ticket to FDIC resolution over the long run. And then, of course, their third best customer was Asian central banks. And we knew at that point, export growth was still negative year on year. We're going through restructuring of global supply chains. So they'd lost their best customer base. So when the Fed had that hawkish moment in September, they really triggered a acceleration of that bear steepening, which is the absolute worst way to disinvert the curve because it causes massive losses on bank balance sheets because of all their holdings of securities. So,
okay. So they have this third mistake. Bond market goes no bid. They eventually hit a point where they go and they acknowledge that the tightening of financial conditions is doing the work for them, and they pull back. I'm curious, though, what your interpretation is as to why they have gone back and pulled back even more than, let's just say, if we were just using financial conditions as a guidepost, that once they kind of reversed the pain that they caused in September, the financial conditions have gotten even more loose, yet they're continuing to be even more dovish.
Yeah,
how do you square that?
This is where it gets. I'm not even sure what the correct adjective for this is, but they are stumbling around in part likely because of a lack of capital markets experience. Maybe the new president of the St. Louis Fed, who worked for Paul Tudor Jones at one time, will help this somewhat. Certainly the loss of Rob Kaplan was a blow to their understanding of how capital markets work. But from September, within weeks, they realized that they had exacerbated this bear steepening, and they essentially, through a series of speeches, instituted what I would call a policy put. And at the time I said, listen, if 10s are at 5, the Fed's hiking cycle is done, right? And so they recognized that they had tightened, or financial conditions had tightened beyond what they were expecting them to do. So that was the policy put. They also, within that September forecast, had this really curious forecast for a fairly significant uptick in core inflation in the fourth quarter. I can't imagine for the life of me why they thought that was going to happen, because it was very clear that core goods prices were undergoing a second round deflationary shock out of China. Chinese import prices are now falling at a 3% annualized rate. The dollar had strengthened decidedly through that whole August through late October bear steepening sell-off. And so import prices were going to start exerting a disinflationary impulse on goods prices. And so turns out, of course, that inflation did not go up in the fourth quarter. It went down somewhat. And that's what ultimately got them to pause and then kind of pivot. I think we learned in the last week or so that it wasn't a real pivot. Sure, they've acknowledged that they're done and the next move will undoubtedly be lower, but we now are into this dilemma that I'm describing as the quadrilemma, or the 4 fours. And what I mean by that is most of the participants on the Fed have not given up worshiping at the altar of the Phillips curve. And so, again, back to my necessary and sufficient condition, they still believe, and it was, there were a couple of elements in this in the minutes, that in order to get core non-housing services inflation to fall, they're going to need additional labor market slack. So let's just consider for a minute the Powell-flation model that he put forward in November of 2022. In essence, he said, we're focusing on rent of shelter, which is running at 5% on a 6-month annualized basis right now. Remember, 6-month annualized inflation is all the rage. The Fed whisperer, Timorous, mentions that in every one of his articles. So we could kind of watch that one now. Right. So shelter's running at 5.1, actually. It's going to come down because it's lapping a series of 0.75 monthly prints for the next couple of months. That'll put somewhat downward pressure on it, but it's not going back to 3 where it was pre-pandemic anytime soon. We then have non-housing services, which the Fed believes needs wage growth to slow. That's running at 4. And core goods inflation is running at negative 2.5%. This is critical. The only reason we had 2% or slightly below inflation through the entire 2010s was because core goods prices were running at 0 for almost a 20-year period. That was a function of China and the former Soviet bloc getting integrated into global supply chains and putting downward pressure on goods prices. Well, right now, goods prices, because of the second wave of deflation out of China, are running at the most deflationary levels that they were at in the early years after China was admitted into WTO in 2003 and 2004. So betting on that persisting, particularly when you're going to start lapping tough comps and you can already see Asian export growth starting to improve, so likely that deflationary impulse is dissipating, is really a bad bet. So that brings me back to the labor market and my 4 fours I keep teasing. So here's my 4 fours. In order to get the Fed to cut to 4, which is the market expectations and what I believe it will take in order to disinvert the Treasury curve and open up the bank credit channel, which is important for refinancing all the million multifamily units that are being financed by construction loans that'll have to be refinanced into multifamily loans. That's almost all financed through small regional banks in order to open up the credit spigot for small business, primarily floating rate loans, and lower that price in order to get the banking system to help facilitate the $7 trillion of government debt that needs to be rolled this year, plus $2 trillion of new debt. You'll need to disinvert the curve. So to get the funds rate to 4, And to keep the 10-year Treasury yield in the vicinity of 4, we need two things to happen to the labor market that also relate to 4. We need the unemployment rate to go above 4, which I do think will happen. And we need average hourly earnings to go decidedly below 4, which I also believe will happen. But as those two things happen, there's likely to be a real growth scare or questioning of 12% earnings growth in 2024. So to me, it's, I don't know, maybe I'm dating myself with this reference, but there was an old Pepperidge Farm commercial, some guy in Vermont, you can't get there from here, right? And so that's kind of where we're at, is this difficult dynamic. How do we get straight to this nirvana where the Fed's cut to 4, the unemployment rate's above 4, but not spiking higher. We're not really worried about growth. And, we're just on our merry way. And I just don't believe that the outlook for the first half of the year is all that good as a consequence of all that.
So now, if you think that the unemployment is going to rise to 4, that triggers the SOM rule, doesn't it? Isn't it kind of implicit in there that we're going to have a recession?
We certainly could do. I think the argument about a recession, I have two general comments about that. First of all, from an investor perspective, we already had one. We had 3 negative quarters of earnings growth. We had 3 negative quarters of the net operating surplus for private sector enterprises, which is the corporate input to gross domestic income, which better measures the business cycle. At one point, we had 2 negative quarters of GDI, but one got revised away. So we had already something of an earnings recession. We've had the manufacturing sector in contraction for 14 months. That's more likely to come marginally out of that. We had a recession in the residential housing market as well. We do have commercial problems and construction problems on the multifamily and office side. Could we have something that gets the NBER at least considering there being a recession if the SOM rule was triggered? Sure. I think that's possible. I don't think it's likely to be deep, because you're unlikely to have all these parts of the economy contracting on a synchronized basis. I should have mentioned, we also had a very deep inventory contraction and now recovery cycle there. So, inventories, residential investment, and manufacturing have already had something of a contraction. If we then had a weakening of the labor market, softening of consumption, at least you wouldn't have these other sectors exacerbating that and causing a deeper contraction. But it does really raise a question about whether we're going to have a V-shaped recovery in earnings or not out of that, marginal, fairly shallow earnings recession, 6% or so over 3 quarters, meaning fourth quarter 22 and the first half of 23.
Now, one of the things that you've mentioned is that rise to 4% of unemployment is necessary for the Fed to cut to 4. Obviously, one of the other kind of alternatives is that we don't get a rise in unemployment and everything stays somewhat strong. And at that point, how would you envision it playing out in terms of the economy and markets?
Well, then I think we're gonna pivot back to this question about financing government debt and the level of rates, and that's a very worthwhile discussion. And I know some people don't really love term premium models, but we'll use them as a reference point nonetheless. The term premium on 10-year treasuries is negative 25 basis points. If you look at, and I constructed a 2s, 10s term premium curve just to get a sense of how that's progressed over the last 50 years or so. And you can clearly see the QE era drove term premiums down to negative levels. That was the primary catalyst for having negative term premium. But of course, we have the highest levels of debt relative to the size of the economy. There's arguments we should be measuring it versus the stock of wealth, not versus the size of the economy. That's a flow variable. The other one's a stock variable. That notwithstanding, there's no doubt that we have excessive amounts of debt and we've lost the buyers for that debt. The Asian central banks were giant buyers in the early 2000s. Then it was central banks buying it in the 2010s. And a 4% 10-year with inflation that's likely to settle, in my view, closer to 3 means that we need a real rate of at least 200 basis points. We're close to that now. And quite frankly, the average during that period when the Asian central banks were accumulating a lot of treasuries in the period before the global financial crisis, the average was about 210. So to me, that's a 5% 10-year, not a 4% 10-year, right? If the Fed is not going to cut to 4, we're more likely to see 10s at 5 than we are to see 10s at 4. In which case, we're back into the spot we were in last fall with this bear steepening where the banking system is still dealing with losses in their balance sheet. And the credit spigot could open a little bit, at least from the big banks. But man, that's just not the right way to disinvert the curve.
So am I correct in saying that you're somewhat cautious about the stock market because either we're going to get a situation where the economy doesn't roll over and the bond market is going to back up, yields will go back higher, and then, stock bond correlation is pretty positive these days. So most likely as yields go up, the stock market will go down, or we're going to have an actual slowdown in the economy and earnings will struggle.
Exactly.
All right.
Exactly.
Sorry, go ahead. Finish your thought. Sorry.
No, I was just going to say, I do think that scenario is likely to unfold in the first half of the year. And as we get to the other side, because of some of the reasons I mentioned earlier about having gone through struggles in different parts of the economy, it's unlikely that this will lead to another 22-like episode. So my forecast for the end of the year is actually that the equity market will have positive returns. But we just, unlike last year where the first part of the market was, the conditions were really favorable, disinflation was accelerating, the liquidity environment was abundant, and we followed that disinflationary path to higher stock prices for a time. I think this year will be the opposite, or flipped on its head.
Okay. And now one of the things that's also kind of changed with the Fed with their pivot is also being Lori Logan's recent comments that she might pull back on QT, or they might pull back on QT. I was wondering what you think drove that and how that's going to play out.
Yeah, you can get really deep in the weeds on this, and I'll try and keep it as a high level as I can. I think the bottom line is all of these things are going to add up to additional duration in the market. And so I mentioned earlier that I thought the actions of the Treasury have been, in a lot of ways, more impactful than the Fed over the last couple of years. I just provide a little bit of background on that. When Janet Yellen got her role as Treasury Secretary and sat at her desk in February of 2021, Steve Mnuchin had built up $1.7 trillion in their checking account at the Fed, known as the Treasury General Account. Now, a bunch of people dunked on Stan Druckenmiller for having said at the Robinhood Investor Conference last October, which I attended, that she should have been extending duration at that point. I love Stan. I think he misspoke a little bit because it's not that she should have extended duration and in her issuance. She just stopped issuing. So she drained that account from $1.7 trillion to $50 billion by September. So she injected something like $1.65 trillion into the economy in a 7-month period. The Fed bought $1.5 trillion of securities through that entire year. So she injected more money in a shorter period of time and then set off all of those events that occurred, right? The meme stock craze, the crypto craze, upside skew on tech stocks being more expensive than downside skew. All that stuff that went on was really exacerbated by the actions of the Treasury.
Barry, can I jump in here? Do you think they understand that? Because I get a feeling like I've been confused about it as well. They use this TGA and think about it as just they're like, they run it up and down, and I don't think they're thinking enough about what it does to the economy and markets.
I got asked the same question by a former Fed serious insider, and I said my answer to him was, I do, because remember what the Biden administration's policies were in early 2021. That was when they passed the $1.9 trillion stimulus. They sent checks around to everyone to the tune of, some $500 billion and cutting issuance they knew was going to inject a lot of liquidity into the banking system. And they still believed the economy needed as much liquidity as it could possibly get. Okay. So I think they knew what they were doing. By the same token, in early 2022, when the Fed was dragging their feet about tapering QE and getting started with the rate hikes, Treasury rebuilt that balance from zero effectively to $900 billion in 4 months and kicked off the 10-month risk-off liquidity drain that went on. So remember now, we've gone through that background. So I think they know what they're doing. They couldn't issue at all in the first half of last year because of the debt ceiling, and the battle about that in Congress. So that prevented them from issuing any securities. Their TGA got drawn down. They initially issued a bunch of bills that got partially funded out of the RRP program. But then they announced they were going to sell some more coupon securities in August, and then we started off that bear steepening move. So here's a broad way to think about liquidity. You take Fed assets owned outright. The other side of that is obviously reserves and any other liquidity that's been created. You subtract TJA because that money is sitting idly, not able to be relent into the economy, and RRP balances, which are also sitting idly. They're earning interest at least, unlike TJA, but they're not being relent in the economy. And then you assume that all those bank reserves is private sector liquidity. Well, that's true unless banks are hoarding reserves. And particularly in the case of small banks, if you look at the weekly Fed data, it looks like banks are building cash. They were selling securities holdings in the small banks, which are banks ranked 26 through everything else, which is a big deal in the U.S., not so much in Canada, but big deal in the U.S. Those holdings fell at a 16% annualized rate. So they sold securities, built cash, cut loans, built cash. That's why those reserves are kind of sticky. Same thing happened in 1937 and 38, and that caused the recession within a depression, but story for another day, I suppose.
Right.
Anyway, so here we're at. RRP balances are falling sharply. I suspect that Logan is getting guidance from the banks that, we're probably not going to, we're raising those reserves in part in front of the proposed capital increases that Barr's pushing so hard on. And he and Bowman, by the way, are having a very public fight about this. This is a real Republican versus Democrat issue as to whether capital requirements get raised in the U.S., the Basel Endgames, the changes to the Community Reinvestment Act that will impact small banks. Anyway, setting all that aside, they are getting worried that as that RRP balance gets towards zero, the system could start to get tight. We had a little spikes in repo rates. So the interesting thing about this is, I'm sitting on a chairlift on Saturday and I get this pop-up that Logan says, we might have to slow QT. I'd written about it actually that morning, the previous day, published that morning, because it was in the minutes. So it was clear that she was the one pushing this agenda. The bulk of her speech, though, was about how financial conditions have loosened. And that could be a problem for them and something of an inflationary risk. The clear implications are maybe they shouldn't cut all that much. So let's say we follow Logan's prescription, if you will, down its natural path. Fewer rate cuts and stopping QT. Well, what's that going to do to the Treasury curve? It's going to deepen the inversion even further. Unless, of course, they decide to restructure QT, which they could do. They could decide we're going to let the mortgages keep going, and any maturing mortgages we're going to reinvest into Treasury bills. Okay, that would put some duration in the market. When Treasury announces their next quarterly refunding in early February, remember what they did in October was they increased bill issuance above the Treasury Borrowing Advisory Committee's prescribed 15 to 20% of total issuance. They're issuing actually more bills than that. That's why RRP is getting drawn down in part. They also increased issuance in the belly of the curve, 2s to 7s, but that's that part of the market that the banking system finances. And of course, as I mentioned, with the curve deeply inverted, the banking system wants no part of 5-year note treasuries at 4% when they pay 5% for deposits. So, one way or another, either the Treasury has to increase the duration of what they issue, the Fed has to restructure QT and allow duration into the market and replace it with bills, go back to something like a bills only policy like they had in the 50s or 60s. But all those things add up to more duration. Right now, they pulled a couple of fast ones to try and stabilize the back end of the Treasury market back in October when 10s went to 5. But we still have the same problem. All those things was really Band-Aids.
Right. One of the things that always struck me about QE and QT is that the Fed uses QE as a policy tool and has never kind of considered using QT as a policy tool. And that just seems wrong to me. Like I think back to, you described the policy mistakes they made, the 3 kind of hikes that they were too hawkish on. Instead of doing the hikes so hawkish, I think that they would have been much better off increasing QT at the point.
Yeah, I was all over, my writings, the press. I remember having this debate with Becky Quick at in December of 2022, just before 2021, actually, just before they got the process started, and saying, just using their rate policy tool made no sense. If you think about the easing process, it was 150 basis points of cuts, and then the equivalent of 250 basis points of cuts in terms of the amount of securities they bought. Roughly, there are models that have been done on this say something like 550 billion of QE is worth a quarter of a point in rate cuts, right? So They essentially did mostly asset purchases to ease. And then when they hiked, they did all rate hikes and very passive QT. That to me was a major mistake. At the time, with the level of rates, the tightness of mortgage spreads, they could have been at a minimum selling, 5 and 10-year treasuries into the market. Certainly the Bank of England does that. And they wouldn't have had this deep yield curve inversion that would have triggered, we might not have even had, as incompetent as those people were, we might not have even had Silicon Valley Bank go under. At least First Republic Bank wouldn't have had to have been sold to JP Morgan, and we wouldn't have those giant losses on Bank of America's balance sheet, and the losses that are acting as ballast on everyone's, all these banks' balance sheets. So I absolutely agree. They should have been much more active with QT, and they wouldn't have had to hike the front rate nearly as much.
I'm preaching to the converted, obviously. All right, Barry, we're going to wrap it up, but I'm just going to ask you one last thing. What do you think is going to be the biggest surprise in the markets in the next, let's say in the next quarter?
I think this back end duration issue is a big one. We had the household sector rush out and buy a lot of treasuries after the Fed announced they were done. I hear a lot of people say that the 60-40 model's back on, that treasuries are fine. You can buy them here and you can earn out at least the coupon. Maybe you don't get any capital gains on it, but I actually think that we're likely to struggle in the back end of the market and back up. Even if we do get the scenario where the unemployment or the labor market starts to weaken, we still have this problem where essentially what the Treasury and Fed did is a little more than a Band-Aid. So I would think 10-year yields going up will probably shock a lot of people, and I think it's reasonably probable.
That's great.
I also think as a ancillary to all the talk about small caps outperforming this year and financials starting to perform well, those don't work in the scenario that I've described. They could work if the labor market deteriorates and the Fed does start cutting aggressively. They could start working from that point, but it's too early for that trade. That what keeps getting called healthy broadening out, it's too early for that.
Awesome. Barry, it's always a pleasure having you on. Why don't you tell people where they can find more of this great stuff?
Oh, absolutely. So Ironsides Macro.substack.com is where I publish my weekly. And I have a product that I think I've tried to make reasonably approachable, although my client base has been institutional for most of my career, but I have lots of wealth advisors, sophisticated individuals subscribing to it. I can also be found on Twitter and LinkedIn. Furthermore, though, I do have institutional clients that, pay me through voting systems. And I have a relationship with Macro Risk Advisors, Dean Kernet's derivative-based New York broker-dealer. And you can access research if you pay for it the old-fashioned way with trading commissions through Dean and the boys. And Dean and I create some additional research product as well.
Oh, that's great. Actually, Dean, that's my favorite podcast. Don't tell Patrick. Anyway, listen, it's always, as I said, it's always a pleasure having you on. I love hearing your insights. Thank you for your time, Barry.
I appreciate it. Thanks.